Well, hello, folks. My name is benjaminzmiller, and in this video, I want to talk about a question that sometimes people ask me. Why would anyone buy bonds if there's inflation? I talk to a lot of business people, and some of them will say things like, oh, I wouldn't want a bond. The government's printing money. There's a lot of inflation, and I got to get some gold or some silver. I got to do this. I got to do that. We'll talk about not my personal opinion. We're going to talk about a Nobel Prize winning economist. This Nobel Prize winning economist, his name was Markowitz, and he actually won the Nobel Prize for some of his work on efficient portfolio theory. And if any of you have accounts that are at Merrill Lynch or BlackRock or Bank of America, they just love this theory, and they actually use it even today, derivatives of it, in the way that they build portfolios. But it's kind of interesting, even though Markowitz made this complicated theory with a lot of mathematics, when it came to his own portfolio, he did it a little bit differently. He would put half of his money in stocks and half of his money in bonds. Sure, he made a great theory, and it's something that academics love. And, I'm not saying that it doesn't have value. I think it certainly has some value, some of his ideas. But when it came to his own portfolio, he didn't use all that stuff. He kept it simple. He put half in stocks and he put half in bonds. And you might ask yourself, with my own portfolio, what percentage of it's in stocks and what percentage of it's in bonds? He would just once a year, he would adjust because he didn't want to end up in a situation where where he missed out. If the stock market went down, a lot of people, they forget that stock market can also go down. If you have 100% of your money in stocks, you're not going to feel so smart when it goes down. But if you've got half in bonds, half in stocks, you can reposition. You can sell some bonds and you can buy some stocks. Or let's say that what happens is the opposite. You can reverse it the other way. So Alamo Mortgage Holdings, if you're a UK accredited investor, and this is a financial product that we have, it's a bond, a corporate income bond, a high yield corporate income bond offered by Alamo Mortgage Holdings. You can actually look at our website at www.alamomortgageholdings.co.uk. Sometimes people say, well, why would I invest in bonds, and why are you doing things with the mortgage market in Texas? What Alamo does is we offer a bond in the United Kingdom to accredited investors. They purchase the bond, and then we purchase packages of mortgages in the United States. But not just in the United States, we limit it to one state. We focus only on the state of Texas, and that's because our team has experience in Texas. We've got a really great team. You can check it out. And with that, we're able to earn very high yields for our bondholders, where they can earn hundreds of basis points more than they could potentially earn on UK gilts and other government bonds. So it's definitely an advantage if you like more. If you like more, you're going to love Alamo. So we chose Texas for a lot of reasons. Texas is home of 49 Fortune 500 headquarters. There's so many companies moving into Texas now. All of the different changes going on. Texas is a state that's winning, and that is part of the reason we chose that. The civilian workforce in Texas, there's 14 million, and it's the second largest workforce in the entire nation. It has the third highest high school completion rate, lots of higher educations, just tremendous things going on in Texas. And as a result of all of the people moving to Texas, it drives up the real estate prices in Texas. And when these real estate prices are driven up, that's good for Alamo because our corporate income bonds are backed by real estate. So it is a fantastic thing. It's a fantastic thing that's there. Sometimes people will say, well, Ben, that sounds great, but what about if the real estate prices fall? That's gonna create a problem for Alamo, isn't it? And I say, no, actually, it's not. If the real estate prices fall, first of all, we're not buying everything at 100 cents on the dollar. We're buying at a discount. We're buying at a discount. We're buying the debt at a discount. So, yeah, I mean, if the real estate prices fall, we just, as we continue rolling forward, it'll average out. But we have a safety mechanism in there. And we also have something that's called reserves. We've got reserves so we can weather anything like that. We're very conservative in the way that we do business, and that's important. That's just simply important. If you'd like more information on Alamo, just send me an email, ben.miller at allomomortgageholdings.co.uk. Once again, that's ben.miller at allomomortgageholdings.co.uk, ben.miller at allomomortgageholdings.co.uk. I hope that helps, and I wish you good luck with your investing.